Welcome to the final part of our series with Paolo Boero, where we delve into the intersection of venture capital and PropTech. In this segment, Paolo and Matt unpack the challenges and opportunities of navigating the PropTech space, balancing innovation with operational experience. We'll explore how venture capital influences scaling strategies, the unique dynamics of tech-driven real estate solutions, and lessons learned from building businesses that combine profitability with forward-thinking technology. Let's dive into how PropTech is shaping the future of real estate and beyond.
I want to fast forward now to Stellify. And, now you have gone through the iterations of the businesses that you were building. You guys met, started chatting, and now Stellify. What's different about Stellify than what you've done in the past?
The story is of how we built these companies is really, we were entrepreneurs,
right.
Just happened to be operating in real estate.
Mm-hmm.
I think the big difference would be we bootstrapped everything.
Mm-hmm.
We never really took outside capital to help accelerate things.
Mm-hmm.
So we had this mindset when we built our businesses that, profit was one. If you don't operate profitably, you have no money to reinvest into your business and
right.
to grow it. And that was sort of our, how we thought about everything is like, you got to earn. We didn't have big savings or money, any of us. So we also had to pay bills, right? That was sort of how we built our businesses. And then you go into venture capital where you're raising money to accelerate that growth. You're hiring ahead of profit, ahead of revenue. So I think that's sort of the only sort of different dynamic. And we came in and really wanted to strike a balance to what we saw out there in the market and maybe how we operated our own businesses, because we very much, looking back, would have taken outside capital to sort of capitalize our business from the right partner, would have really helped accelerate things. I mean, I think some of the learnings we would have gotten wouldn't really even be that diminished, because after a year, 2 years, at some point there's diminishing returns
right.
on what you're learning. I think we surpassed those diminishing returns when we were growing out these various parts of the businesses. I think there's always learning that
mm-hmm.
goes on,
yeah.
But I think that's the major difference was going into venture capital. You have that opportunity to make the right hires, to position your business for scale
mm-hmm.
right off the bat, as opposed to having to make so many sort of sacrifices. And there's just such an opportunity cost to everything you do when you're bootstrapping. Where we kind of came in, we were like, at the time, like the anti-VC, because early on, we were very much pushing and investing in businesses that were careful about how much money they were raising, careful about dilution, careful about an understanding path to profitability, because from our opinion, it gave them optionality in the future. If you're forced into this scenario where you have to raise or die, you no longer have control over your own
right.
destiny.
Right.
And some things are outside of your control, like the market.
Paolo Boero recounts building businesses through bootstrapping, prioritizing profitability for growth due to limited savings. While recognizing the scaling advantages of venture capital, or VC, he highlights its risks, such as funding dependency and reduced control. Boero reflects that partnering with the right investors could have accelerated growth of their company, but stresses the importance of careful fundraising, profitability, and maintaining independence to avoid a raise or die scenario.
That's the question I was coming back to and thinking in my head as you were talking about this. Building and finding deals and all that is one process, right? But there's an entire other dynamic, and that's just what the market's doing real estate wise. And so what's the difference between doing it your way, bootstrapping, funding yourself, and VC when the market drops? When the market falls, like, so we have a 2020 and all of a sudden property values are like, they're not growing the way you thought. So do you have more flexibility? I think that's what you were alluding to. People that are more careful and don't raise too much at once, have more optionality in various markets. Is that what you meant?
They can control their destiny more, right? I think there's this high failure rate that exists in venture capital because of the way that venture capital is invested, which pushes founders to grow sort of at all costs. That can be good when it works well. Like you can grow really fast. You get exit velocity much quicker. You can get to $1 billion valuation in a number of, maybe it's a year, 2 years, 3 years, if everything goes well, as opposed to over a 20-year period, right? If you're sort of bootstrapping, but you have to be cautious in how you're doing that. And fundamentals still matter. The fundamentals of a business, revenue first, like those things matter.
Right.
And if you get away from that, selling a vision too far in the future, where commercialization is like
a lot more variables
out there,
a lot more variables.
Then you're totally market dependent. What really happened was liquidity dropped out of the market when interest rates went higher, especially out of the private market. And so you've got post-COVID, all this money was pumped into the market. Venture capital was roaring. Valuations were crazy, frothy. Rounds were getting, oversubscribed left and right. And then interest rates sort of abruptly shifted upwards, and that capital left the market. And now where we are, it's like capital's totally dried out in venture capital. And
they're just waiting for rates to drop again, I guess, before they can make it more feasible. A lot of these projects have certain margins built in, and when the cost of capital goes much, much higher or interest rates go up, it's not attractive to remember when we said the LPs are interested in what's in it for me. Well, if it's already built a certain way, it's not attractive because it's there. So maybe I'm waiting on this cash until, I can see more of that.
Yeah. If you think about it, venture capital sort of exists as a pathway to liquidity. And I think probably originally as a pathway to liquidity via the public market. What happened in sort of 2021 is like you've got valuations in the private market that were much higher than public valuations.
Yeah.
You're taking away a path of exit.
Right. You're blocking that road.
Yeah. And there were obviously some IPOs happening, but then you saw companies IPO and then their valuation go down 80%, 70%. So it was clearly not a good path.
Make sure I use layman's terms. Essentially, the VC, their goal is to take some of these projects, the LP, GP projects, fund them in a way to where there's an exit strategy so they can move those into a public market and therefore...
Or to sale.
To sale, and then release that cash back to the investors. And it just kind of becomes then a fund in a public market as one option.
Yeah, and because it takes 7-ish to 10 years, right, for those liquidity events to realize, if they're realized at all, your cash is locked up for a long time, right? So you can't just call your broker up and say, hey, sell my startup shares, right? There are increasingly more secondary activities, and I think that's another important exit avenue, but you can't just do that, right? So it's the most illiquid asset class at a time when there's no liquidity to be allocated.
Right. So when usage cash dries up, that path of going out into a public market has got a roadblock in it. So now you're like, I'm going to sit on these assets until that path opens back up, which could mean,
Yeah, I think the main thing is sort of private valuations that were overvalued in comparison to public. Where public, you have much more liquidity, right? And then when interest rates rose, institutional money was like, well, I want cash flow.
Right.
Or I'm going to put my money where there's liquidity. So the capital allocation shifted away from private. And all of the guys who were in private venture capital, real estate in 2021, post-COVID, they're stuck.
Right.
They're looking at their existing investment from a weighting perspective and saying, well, I wanted 20% of my money in private. I wanted 40% in public. Well, I was expecting this 20 that I allocated back in 2020, 2021 to come back to me already.
Right.
But it's stuck. So I can't afford to put any more money into private right now. I'm going to put it all in the public market until things shift.
Right.
And that provides somebody with a little foresight and who's a little patient where's the value, right? Value is where everybody left. And so, and the value is probably furthest away from liquidity if everyone favors liquidity.
Right.
What I think will probably happen in this cycle, if all of the capital's in credit and all the capital's in the public market, you'll continue to see those valuations get more frothy. The sort of frothy valuations will cycle through in growth equity, and obviously it's already happened in early stage. But as those companies mature, if there's an arbitrage that exists in private to public now, it'll pave the way for that lane to open back up.
A frothy valuation refers to a situation where the value assigned to a company, typically during fundraising rounds or in the stock market, is inflated beyond what its fundamentals, such as revenue, profit, or growth potential, would justify. This often happens during periods of excessive market enthusiasm or speculation, where investors are willing to pay high premiums for companies they believe will grow rapidly. Frothy valuations are characterized by over-optimism, high multiples, speculative momentum, and risk of correction. For example, during the tech boom of 2021, many private companies in the venture capital space were valued at levels that exceeded their counterparts in the public market. When market conditions tightened, many of these valuations were forced to come down, revealing their frothiness.
As soon as that happens, where growth companies are looking, oh, now I can go get liquidity via the public market via IPO. And my value will increase 2x,
right?
Then all the money's going to return back to growth,
right?
Because they're gonna want that immediate arbitrage and exit, and then as soon as that happens, they're going to say, well, I want to go back into early stage to increase velocity back to growth,
right?
That's sort of what I think will happen, and the timing of where we are right now is, where's the value? So I've actually gained a lot more conviction in early stage investing right now because there is no liquidity. Now everybody has adopted what was sort of my philosophy going in was investing in fundamentals, because you can't be sure if a company you invested in early stage will be able to attract more capital. It's not about, it used to be about, I'm going to invest in a great founder who is a great fundraiser who can sell a vision. The problem is that doesn't work anymore because at some point, the vision without traction doesn't mean anything. Right. People are like, okay, this didn't work.
Yeah. Come back to me in a few years.
Right. Yeah. So now when you're investing in early stage, you kind of need to have all of those fundamentals in place to attract investment.
Paolo Boero highlights the risks of venture capital, emphasizing the trade-offs between rapid growth and strong fundamentals. He notes that VCs focused on aggressive scaling can expose companies to market dependency, as seen post-COVID when rising interest rates dried up liquidity. Inflated private valuations in 2021 further disrupted public exits, underscoring the importance of focusing on profitability and sustainable growth.
Which is really neat and just kind of bringing this whole story full circle. Then because of your experience building from the ground up and working with these Class C type and properties and all the pain that you went through to see where every nut and bolt and you can squeeze every bit of revenue, having that knowledge is good now, because now you can see where some of these other investments have done some of that work, and you're like, okay, that gives me more confidence. Make that property more efficient through using software and back to property technology. Then you're just making everything more efficient, and then looking at the efficiencies of the overall investment, not just the property itself, but the efficiencies of the operation, and saying, I'm going to bet on that horse because that horse will be likely to survive a downturn.
Yeah, well, and I think too, one of the things you have to remember about PropTech is that, it's real estate's the world's largest asset class, right? So when you talk about efficiency, if you move the needle a few percentage points, right, you're talking about billions of dollars of value, right? So I think that, that efficiency or that desire, right? The other thing you're also seeing, and we were talking about cycles a little bit, is that you're right now, I think, because there's such a burning need, right? So you have this wall of collateralized securities on commercial office that got pushed out in 2023. They're still here in 2024. There's still a lot more pain. And all of these investors, right? We're talking about the interest rates. You have to have a debt service coverage ratio with your bank, right? And so if your DSCR is you have to produce 1.25 the rent as you need to pay your bank.
DSCR means Debt Service Coverage Ratio. It's a financial metric used to measure a company's ability to cover its debt obligations with its operating income. It's commonly used by lenders and investors to assess the financial health and risk of borrowers, particularly in real estate and business loans. In real estate, DSCR is used to evaluate the ability of a property to generate enough income to pay its mortgage or loan payments. For example, in commercial real estate, a DSCR of 1.25 is often considered the minimum acceptable level. If a company has a net operating income of $200,000 and a total annual debt service of $150,000, this means the company generates 1.33 times the income needed to cover its debt obligations, indicating a relatively healthy financial position.
Well, when your interest rate goes up, so, you have a lot less breathing room, right? And so the only way to generate that efficiency, like this isn't some, we're like an MBA consultant is saying, hey, you should have a more efficient business. Like this is an existential issue for a lot of operators. And so I think that's driving the investment cycle, both in terms of who's going to get land grab, but also the inverse of all the valuations were frothy in 19, 20, and 21 is that there's a lot of real good deals now when there isn't capital, right? You saw that after the great financial crisis, right? And, great venture deals in 2011, 2012. So it's a pretty similar set of issues.
The Guggenheim.
Yeah. Our thesis going in to why we raised the fund, why we decided to double down on PropTech was all based on our experience. We were forced to adopt technology because we had such unscalable assets and such an operationally intensive asset class. And when we looked around at our peers, they had no need, because they were buying institutional larger properties where there was enough margin there. And so their entire focus was, how do I scale? Right? How do I get more properties? Is a volume game. And it didn't matter if they, sort of hit it out of the park or hit a triple or a double, like they were going to make money on each one of these deals they did. It was just a question of how much. So introducing technology was kind of like, I don't care. Like, I don't have time for this. I'd rather focus on finding 5 more deals because, for them, the amount of money they make on those 5 more deals, it was easier. Right. And so our thesis was, okay, well, it's going to take a consolidation in the real estate market for others to reach the same pain point we had and be like, oh, well, I can't get any more deals now. And I have now acquired all these deals without thinking about efficiency management. I've now deals, or whether it be, existing multifamily or any other deal or land, and now you've got to figure out, they're sort of working backwards and having to figure out, okay, where's the savings? Because I'm screwed up.
Now they're looking for those.
Right. And so that was our thesis going in. We were right on the money in terms of the consolidation. We were right on the money in terms of the need. But the difficult part now is are you going to make the right decisions to help yourself out of this jam? Or is the mentality just to do more, faster, better, like sort of like, let's just work harder. And I think that is kind of what we're seeing a lot of.
Paolo Boero explains that their decision to focus on PropTech stemmed from their experience with highly operationally intensive, unscalable assets, which forced them to adopt technology. Unlike peers focused on scaling large institutional properties with sufficient margins, they saw a need for efficiency through technology, particularly as the real estate market consolidated. Their thesis predicted that as deals became harder to find, others would eventually face operational inefficiencies and seek solutions. While they were correct about the market consolidation and the resulting need for technology, they note that many are now at crossroads, either adopting better systems to address inefficiencies or simply doubling down on doing more, faster.
Sounds like, to put it in other words, are you an entrepreneur that's going to figure out this problem, or are you just an operator that's just like going with the status quo? This is how it's done. And
like work harder.
There are people that just do this and they can't think on the fly and they can't adapt and be variable. And that's what it takes in these kind of markets.
Well, they're probably going to go through the same iteration we went through, but the problem is they have to go through it way faster.
Yeah.
Like we went through, we originally were like, oh, we need better people. Mm-hmm. Oh, we need better process. Mm-hmm. We did all those same iterations, but when your asset is underwater, you don't have the luxury to take time or the time to go through each one of those and figure out, okay, which is the right one.
Right.
And the other problem in, sort of providing a solution that they need is oftentimes when you're really in trouble, you can't pay for anything.
Right.
So you're offering a solution to a very price sensitive customer who's like, yeah, I see this, but can I pay half? I think that's sort of the challenge that we're seeing right now. Our mentality with a lot of our portfolio companies is it is very much of a land grab, right? Like if you can provide a solution, you can still figure out a way for your margins to work and discount your price to where the customer will pay for it in this market.
I would imagine because so many people are caught in a situation where their thesis isn't working out, there are some of those that have that cash need. So then there's this land grab where there's that opportunity. It's like, okay, that person's in trouble, they need this, and here's a way to kind of pick that property up in a way that's...
This is where sort of venture and running a business sometimes butt heads.
Yeah.
If you're a venture guy and you're looking at that next round of funding, and that's where I think businesses can sometimes make decisions that are harmful to their business to attract venture capital.
Right.
If you're operating at 80% margins, 90% margins, some sort of SaaS business, right?
SaaS means software as a service. It's a business that provides software applications over the internet, typically through a subscription model. Instead of purchasing and installing software on individual devices, users access it via a web browser, with the provider handling hosting, updates, and maintenance. SaaS businesses focus on delivering convenience and reducing IT overhead for customers. They also ensure consistent updates and support.
And you're decreasing that to 60% in order to meet the needs of a customer right now. Your unit economics are obviously going down.
Right.
And when you go into a fundraising round, they're like, well,
what happened is look like
I don't know if I buy this.
Right.
You're like, how do you generate a price that's like, for a multifamily, a lot of things is per unit.
Yeah.
How does your per unit price go from $1 to $7?
Right.
How does this become $1 billion exit?
Yeah.
If you're thinking along those terms right now, you could really damage your business and not make the right things. And then you take venture capital in order to get the next round of financing, you have to make good on those promises.
Right.
So some of our solutions who are like ResiDesk is a great example. They're winning the market because they can undercut some of their competitors who are in a different situation.
Right.
They've raised venture capital. They're in a high burn situation. They know what targets they have to meet in terms of revenue to attract more capital. Otherwise, they're dead in the water. Mm-hmm. And they can't afford to charge what ResiDesk is charging,
right?
Because it won't get them to the next round. ResiDesk can sit around and burn neutral. They can say, well, we'll just undercut you, we'll wait you out. There's sort of a war of attrition in this type of market, in addition to a land grab. Mm-hmm. And if you're running your business the right way, that's who's going to win.
So now, Stellify, as a VC, you're looking for portfolio companies or companies that come in. What do you look for? I mean, you're looking for these. You said, people that operate better. What other things are you looking for?
Well, I mean, one of the things that Paolo said early on, right, was that we're thesis or problem driven, right? So I'd say that the first half of the portfolio, the story is largely the tech stack around multifamily, right? And looking for solving specific problems in this sort of high need piece of the puzzle. So I think part of it is what are the problems we're curious to solve, which is sort of the initial filter.
I'm just kind of thinking from a perspective of if I'm in the audience listening to this and I'm scratching my head saying, if I'm going to look for a VC partner or someone that understands where I'm going.
Because we're vertically integrated, we sort of looked at it as like an ecosystem that needed to be more connected. For example, we had a maintenance business, right? And so we were looking at maintenance solutions that connected to asset management, property management, that helped you to be more proactive, that gave you a clear ROI, because those are all things that were preventing proactive decision making. That was sort of how we, obviously in our ecosystem, there are issues that we're trying to solve for consistently. And in solving for those, we'll find solutions. And so that's a big part of it. But then I think if we're looking at, because we're not just investing in sort of multifamily, we're investing across real estate, broadly speaking. We do look for certain things in certain characteristics in founders. From my own bias, like I like founders that are scrappy, that are problem solving, that are good operators. Yep. I think I have started to understand the need for someone to be able to articulate the vision well as well. But I think I still prioritize somebody who can execute over somebody who can articulate a vision.
And somebody who has that deep product experience, right, or problem, right?
For
like
sure.
Every business that I think either one of us have started, right? We talked about this earlier. You see a problem and you just sort of can't help but solve it. And I think that that's been uniquely true of all the investments that Stellify has made, right? There's some deep conviction or experience or expertise from whatever the last business was or whatever your prior role was that really causes you to have that level of conviction, right? Because especially now, there's no such thing as a fair weather founder in this market. And so you sort of have to, when we evaluate these businesses, it's not just one or two of these things that has to be true, right? You also have to have the margin, you have to have all those sort of soft characteristics. And so it's a high bar these days, right? Because we get to be choosy given the lack of liquidity in the market. But
it sounds like, and correct me if I'm wrong, PropTech or what Stellify is doing, you both invest in real property and also technology because you're doing this whole ecosystem. So it sounds, and I could be completely wrong, but it sounds like that's completely different than your normal property VC because it's all like buildings and kind of efficiencies, and you roll that into a public market as an exit, and that has different values. For example, if I'm a software company that has solved I'm a tech company that has solved some issues for property, I'd imagine valuations, I just imagine it would operate differently than a multifamily property. Do I have that right or wrong? Or is it kind of the same?
Software definitely is valued very differently. Definitely operates very differently. Definitely has different considerations for sure.
So I'm asking this because from an audience perspective, if I'm out there, if I'm a software developer, I'm like, these guys might be someone I want to go talk to. I just wanted to provide some clarity that is something that you guys look at as part of the portfolio companies. It's not just properties.
Yeah, no, those are two different businesses, right? So Stellify is just investing in software businesses that make the existing real estate value chain better, faster, cheaper is how I think of it.
The discussion clarifies that Stellify focuses on investing in early-stage tech and software businesses that enhance the real estate value chain by making processes more efficient, faster, and cost-effective. Unlike traditional property VC investments that deal with real estate assets and their efficiencies, Stellify's investments are purely in software with no hard asset component. The conversation distinguishes Stellify's approach to building a software ecosystem from investments in physical properties.
Is that in Stellify? You're looking at an ecosystem of software?
We're looking for a solution that addresses the need for a connected ecosystem. Right. There are many examples. an example of that is one of the companies we invested in was a company called Helix Intel. What was a solution that I was looking for operating a maintenance company and really wanting a way to be able to sell preventative maintenance and also wanting a way to be able to justify preventative maintenance from a operator perspective, because the ROI has always been unclear. And what happens is your maintenance guys who will say, hey, if you do preventative maintenance every quarter, you'll end up saving money.
But how much?
And they're like, yeah, sure. Like, I'm not paying you extra money.
Right.
And so like there's a distrust, one, right? And because there's a lack of transparency into that sort of knowledge that maintenance guy has versus asset manager has. Asset manager is also operating off of a very sort of stringent budget and pro forma in order to like that they have with their LPs, where they're like, okay, we need our costs to be X every single month.
Yeah.
So, you know, when the idea of preventative maintenance comes up, they're like, I don't have that in my budget. Show me where it is in my budget.
Yeah.
Right. And so, or show me the ROI.
Right.
Like, so that I can understand how I could do something like this. And so that was a constant problem where they don't do preventative maintenance, then things break. Then they call on our maintenance company to come fix it. And they're like, can we get a discount? This is way more expensive than we were expecting it to be.
Yeah.
The maintenance guys are like frustrated saying, I told you, had you done preventative maintenance on this, you wouldn't have as many things breaking.
Paolo discusses their investment thesis in PropTech, aiming to build connected ecosystems that address inefficiencies across real estate. For example, their investment in Helix Intel tackled challenges in preventative maintenance by integrating energy, insurance, and asset management solutions.
It's the whole, what's the ROI on an oil change? I don't know.
But you have to know, right? Because it's in a...
It's my car will break down at some point much sooner than if I have a regular...
Right. What I was sort of looking for is asset management needs to have an ROI to make a decision, to justify that decision to their LPs, especially if they're spending extra money up front. You need transparency. You need some way to figure that out. What I was sort of looking for is a platform that shows you everything you own, shows you the aging, gives you some analytics on how many times you've addressed that particular piece of equipment, so that you could start to get a much better understanding, so you could level up your understanding from an asset manager standpoint to where the maintenance guy already was. Those HVACs, those particular parts of equipment, and can tell you, hey, this thing needs to be replaced, right? Or this thing needs to be serviced more regularly, or you need to like put in a program for even like filters or something like that, right? So Helix was a system that was addressing that problem, and then also tying in things like insurance and energy, right? So that's sort of the connected ecosystem, right? Because energy cares about that too. They care from a different perspective. They're like, well, if your equipment is better maintained, then your energy costs are going to go down and strain on the grid is going to go down. Insurance is like looking at it from a claims perspective. If you maintain your equipment better, then
longer life,
then not everything is breaking, and we don't have to pay that back in claims. And they have such bad data right now that claims are outpacing their premiums, and they're losing money. So they need this. They need sort of more proactive data in order to make better decisions. And so Helix Intel we saw as a solution that was connecting all of those parts of the ecosystem that operate around real estate and directly in real estate. And the other important thing is we look at solutions that have crossover, right? So Helix, its initial sort of go-to-market was based in multifamily, but it's actually found the low-hanging fruit is in municipal and schools. It's sort of shifted gears towards another area entirely, but will obviously still has the same crossover to multifamily, to office, and to any other asset class.
What are the differences between, what have you guys found, the differences between a VC that focuses on only property and real property and a VC that focuses on software? Can you explain the nuances? That's a question for you too.
So yeah, I mean, I think the way that people usually talk about that as a generalist VC versus a PropTech VC, right? So I think that's sort of the first piece, right? So when you're a generalist, you just have a lot more flexibility in terms of what you are willing to invest in or able to invest in given your mandate. So I think that's one of the big differences, right? Is we have chosen to go a whole lot deeper in one area than going real broad, right? That was something you said last time, like you could go so broad that you become a jack of all trades and a master of none. And so I think that's something that we were conscious of or continue to be conscious of. Not the generalists fall into that, right? But you are seeing more and more specialization, and you're also seeing that the returns are better for small specialist funds, right? So I think that's a big difference, sort of right off the bat. And then
is there a timing difference too, as far as, I mean, we talked a little bit ago about having to wait out the market in some of these plays from as a VC, you go into public markets, but if I'm dealing with software, that's an entirely different market than property, or is it intertwined?
I mean, they're different customers, right? So like, I think that this market looks an awful lot like ed tech from kind of the early 2010s, where the buyers are all of a sudden different, right? So you're not selling to Salesforce, you're selling to Los Angeles school district, right? And they're not sophisticated buyers of technology. And so there's all sorts of things that happen in that market. I think real estate's really the same. You have this relationship driven industry, and all of a sudden you're trying to ask them to buy and deploy software, right? Which is one, a mindset shift, right? But then two, they still want to have those things referred to them as from relationships that they trust, right? So if your asset management buddy that you have drinks with says, oh my gosh, this piece of software has saved me 20 hours a week and my boss is going to give me a promotion because all my properties are doing better, that's a much more interesting kind of referral than what you might see in sort of a more generalist approach.
Yeah.
Matt explains the nuanced differences between PropTech-focused VCs and generalists. Their focus is on leveraging technology to solve specific problems within real estate, aligning with their operational expertise. This specialization enables them to create value in both traditional real estate and tech investments.
So there's a relation, and it's just almost teaching some of those individuals something more unique. Also, I would imagine there's all kinds of cycles in the market. The property cycle and also the software cycle might be completely different as far as, do you raise a certain dollar amount and say this is what fund one is, and we're going to deploy these solutions in fund one and go do a public market thing versus like what you did before? Or is that kind of different?
I actually think they're pretty correlated. Money that goes into real estate, it's a liquid.
Right.
Money that goes into venture, it's a liquid.
Right.
It's the same sort of decision that you're making. Obviously, the difference between real estate and venture, there's some yield that you get from a real estate investment, typically, unless you're doing like a development.
Yeah.
And I think it's often much more clear of your timeline, but not always.
Got it.
I do think in terms of when the opportunity is, like when those things are doing well, they're probably pretty correlated, not separate. To your original question, PropTech versus real properties, there are a lot of groups out there that have call it corporate VCs, right? That have a portfolio and they want to leverage that portfolio into sort of venture.
Right.
I think what we haven't seen is groups be able to do that successfully in early stage and do so in a way that successfully connects their core business to the venture part of their business. What we see in a lot of corporate VCs is difficulty in that connection because it's difficult, especially in early stage. You're asking your property manager, your developer, whatever, to become crucial to that feedback process of the early stage product, which is often not perfect. It's just too much strain on the core business for an enormous company to roll out a new solution. You need sort of mid-market groups.
Yeah.
Because they're going to be the earlier adopters, not the large institutional groups that
they're
are
more nimble and they have less to risk.
Yeah, and that's one of the differences that you see in those customers, right? Is you sell a piece of software to an institutional operator, and they'll pay, they'll roll it out to some small percentage of the portfolio, and then once they decide that it works, right, then they roll it out to 100% of the portfolio, because once you achieve scale, that's where the real savings are, right? And that's just a very different sales process where you sort of get that interview, right? And then you have to execute, and it's sort of you get everything or you get fired after that.
Yeah. Awesome. Well, this has been very educational, and it's right in line with navigating complexity. We dove into the complexities of VC, the complexities of starting your own business and kind of going down that path and what you've learned from there. Life is just a series of just kind of learnings, and we just continue down the journey. So thank you both for being here.
Yeah, thank you,
for
Jeff.
having us.
Thanks, Paolo. Appreciate it.
Yeah.
Cool.
And that concludes our 3-part series with Paolo Boero on navigating complexity. Dan closed the discussion by emphasizing the importance of learning through iteration, while Paolo and Matt shared how their focus on balancing operational experience with innovation, particularly in the world of PropTech, has been crucial in navigating evolving market challenges. Thank you for joining us for this insightful series, and stay tuned for more conversations that explore the intersection of strategy, technology, and growth. See you on the next episode of Navigating Complexity with Matt McDonnell and Dan Dillard.